let's look at Spirit Airlines. So the market cap is $2 billion and the stock price is $22.62. So now we know the shares outstanding. That's the market cap divided by stock price gives you the shares outstanding. And let's enter the free cash flow. We'll go back to Yahoo, go to the financials, go to cash flow, and on the bottom is free cash flow. And it's not a good sign that 3 out of the 4 years they had negative free cash flow. So free cash flow is operating cash flow minus CapEx. So negatives can occur in new businesses or businesses that are investing a lot of money. In this case, they're just not making enough money to cover their costs. Now let's get the net income. That's on the income statement. And that's positive every year. That's the profit and loss for a given time period. So it's possible to have positive net income and negative free cash flow, because net income is profit, so you would think it would be similar to free cash flow, but it's not. What happens is in a company like this, they're spending more money than they're bringing in, so they have to go deeper into debt every year. So for 3 years in a row, they had $250 million of negative cash and $360 million and $287 million. So all 3 years they had to borrow in order to just operate their business. Net income, the reason it's positive is because there's a lot of non-cash items on the income statement. So when they depreciate things or when they pass through losses or gains, it could make the net income positive even though you're actually losing money in the business. Let's get the revenue, and we'll put that into the model. And now we need the capital structure of Spirit so we know what to discount the future cash flows by. So the interest they pay on the debt is $77 million, and let's see how much debt they have. So current debt is $258 million. And non-current debt is $2 billion. So they pay 3.5% interest on the debt, but interest payments are tax deductible. So let's get their effective tax rate. So income before tax and income tax. So the cost of the debt is 2.7%, but more than half of the capital structure is debt, 53% debt. So that's pretty leveraged. But let's move on. Let's figure out that cost of equity. We need the beta for that. It's 1.28. So beta is the volatility of the stock. So beta of 1 means the stock moves with the market. Beta of 2 means the stock moves twice as much as the market. So this means it moves 1 1/4 of the market. So if the market goes up 100, or the market goes up 1%, this would go up 1.28%. And if the market went down 1%, this stock should go down 1.28%. And in order to calculate the weighted average cost of capital, we have to combine the cost of equity, which is 12.15%, and the cost of debt, 2.7%. And we get a 7.18% WACC. And that's what we have to discount the future free cash flows by. And we estimated 4 years of free cash flow. Then we did a terminal value, which is all years after year 4. Then we discounted those numbers back to today, and we get a value of the company of $3 billion. And we divide that number by 88 million shares. We get a stock price of $34. And it's actually trading at $23. So according to the model, it's a discount. So it's a buy. Just so you know, I have 4 models, and 3 of the models came back with a negative stock price. So this is the most conservative model. It's the least aggressive. Just keep that in mind, because it's really hard to value companies that have so much negative stuff in it, like negative free cash flow. And I also had to pull what the analyst expected revenue is for 2020, that 1.8 billion. I can show you where I pulled it from. If you go to the analysis section, that 1.8 billion is the analyst estimates for 2020. So I took that number and I based my future revenue off of that number. If I would have kept the revenue the same, it would have had over $4 billion in revenue in 2020, which would never happen with coronavirus. And also, I think it's important, people need to understand that stock prices are based off of the supply and demand of the market. It's not really based off of how a company's doing. So companies can be doing really well financially, and their stock prices can go down, or companies can be doing really poorly financially, and their stock prices go up. So it's just really about how the market perceives the stock. And the three indicators are fundamental factors, which is what we looked at, and that's what I base my investing decisions on: the earnings, net income, revenue, all those things. The technical factors, which are more external, like inflation and competition, and the market sentiment, which is how people perceive the business. So they might perceive Spirit as a struggling business because it's an airline, and everybody perceives airlines as having a weak business model. And you can tell this is true from their stock price. You can see how it's been dropping and hasn't really come up too far. It's only at 23, so it's really less than half of what it was just 3 to 6 months ago, or even a third of what it was 6 months ago or 9 months ago. So it's dropped a lot. So let's look at the ratios to see how they stack up against their competitors. We need the current assets of the balance sheet. And that's 1.4 billion. And let's get their current liabilities, and then we'll get their equity. So the current assets are pretty much cash, accounts receivable, and inventory. And these are the assets that can be converted to cash within 12 months. And they have 1.4 billion. Current liabilities are short-term obligations that are due within a year. Accounts payable and short-term debt are the most common. And they have 1.1 billion. So that's good. You want current assets above current liabilities. If that was not the case, then they would have to borrow money just to fund their day-to-day operations. And then equity is on the balance sheet, and if you wanted to calculate it, it's their total assets minus total liabilities. So it's what we call the book value, or net assets. It's the value of the firm as per the balance sheet. And let's see how the ratios look. So the PE is the most common ratio, price over earnings. And I look for under 15 when I invest in a company. They have 6, which is a really good PE. Price to sales is 2. I look for under 2.2. They have 0.5. That's the stock price over the sales per share. And price to book is under 1, which implies this is a really good investment. A low PE may mean an undervalued company. It could also be the result of some serious underlying problems within the company. I think there's a lot of serious problems with the airline industry, with business now, and oil prices really low. I think they're going to really struggle unless people start flying again like they used to, and that could take possibly a few years. So the reason these ratios are so low and they look so attractive is because the stock price has been cut in half or more. So just 3 months ago, the PE was 12. You just double all these numbers. That's what happens when your price gets lower. The ratios look more attractive. That because the numerator is the price. If the denominator gets higher, then the ratio looks attractive. Current ratio is the current assets over current liabilities, and they have a good current ratio. It's where it should be, 1.25. So they have enough cash and short-term assets to fund their business. ROE is not bad. It's 15%. I like to see 20%. That's the net income over equity. And net income is the profit and loss from the balance sheet, and equity is your book value, which is what we input earlier down here. So you always want to compare with the competitors to see how they stack up. So Save they win in one category, the current ratio, because every other airline has under 1, which implies that they don't have enough money to fund their business and they have to borrow. And what happens when you're over leveraged like American and you need to borrow more? You might not be able to borrow and you might go into default. So that's a pretty big concern with a lot of airlines, not just American. A lot of airlines. If interest rates went up to like a normal number, like 5-6%, I'm sure all the airlines would default because there's no way they can afford to pay the interest on the debt and get new debt to pay the old debt. So the PEs are all really low with the airlines, under 15, just because the stock prices come down so much, and it just makes it look more attractive. So all 3 of these are really low. Current ratio only, Spirit is in good shape with that. ROE, they're all okay, except for American, who had a loss in 2019, so they have a negative ROE. And JetBlue has the least debt of the company. So for all the airlines, JetBlue would probably be in the best shape because they have the least debt. They will need to borrow just to maintain the business, but they still won't be as leveraged as these other companies. So let me know what you think in the comments. Thanks for watching the video and hope to see you soon.